Michael, welcome back. I know you're in Australia.
Thank,
What time is it now?
thank you very much. Thanks, Dale. Daylight savings now, it's 25 to midnight. So
Okay, you're burning the
it,
candle tonight.
it's all it's all good. I'm going to share my screen if that's okay with you.
Sure, go ahead. What have you been
Okay.
what have you been up to? Is this what we're gonna
Okay.
find?
Well,
All
yeah,
right.
thanks very much for inviting me back. It's been a couple of months since we've spoken.
Yeah.
Um, I got a couple of things that I can touch on. So, do you mind if I just jump around and share what I
No,
think might be of value
no,
to your audience?
you're free. You have
I'm a free
freedom,
man. Okay,
freedom to express yourself
okay,
and
I like
views
that.
uncensored. I may
Okay,
interrupt you a few times.
no, no,
That's
please,
all.
please do. Just
All
fire away some questions. So,
right, go
so
ahead.
something um, was bugging me on over the weekend and I thought, okay, this morning I woke up and I thought I'll write about it. So, I write a daily global macro newsletter. It's free, so feel free for any of your listeners to read about it. But basically, the sub oopsie the subject I chose was mess something up here. Just I've managed to mess something up
the
in
narrative
my
of a lot
eagerness.
of the narrative of a lot of cash on the sidelines to come into
Okay,
the market.
there we go. Okay, so
Okay.
so basically, um, everyone's a lot of commentators were saying there's a lot of money on the sidelines and it's going to they were kind of implying that it's going to hit the market and um, one of the reasons that was driving it was this the on repo reverse repo basically as the facility has gone away, so it stood at 2.5 trillion um, when was it up to 2021 on the back of all the
Yeah.
stimulus that came with the pandemic, and the Fed has been purposefully they've been applying what they call quantitative tightening QT, and they've achieved their goal. So they've they've the facility's basically empty now. On the flip side of that, there's the $7.5 trillion of money market funds, and because just for some of your listeners or who may not be familiar with it, typically what happens is money market funds that have excess, they've got excess um, surplus money invested, they would put that money at the Fed in the reverse repo market because it was paying a very high interest rate relative to the Fed funds rate. Anyway, the thinking now amongst many analysts is saying, well, this money is now going to be put to use. And I just have to quote John Hussman, who I think is one of the great thinkers out there. And what most people miss is there's no such thing as money going into or out of the market, only a change in who holds it. So I don't want to go into the whole mechanics and the internal plumbing of the monetary system. You can read the article to get a better feel for it. But there is no increase in money. All that happens is it changes hands from one holder to another. And what I feel about this particular argument is that while John Hussman might be correct, and he's pretty technical as a former professor and all the rest of it, he's 100% correct in his statement that there's no new money that's being created. But what can happen is, and one can't dismiss this, is that there could be an increase in the velocity of money. So while there might not be any new money, money could pick up. And he has a chart of the velocity of money, and basically it has been going up since the pandemic. So I mean, that's a whole thing on its own. I just wanted to touch on that. Don't you shouldn't fall for the headline where they say money on the sides is going to be put to work.
So
It's
that's a
no,
bullish
no.
narrative to scare people into the market because
Correct,
they're going to be left behind. So they're trying
correct.
to create FOMO, and you think that would
Exactly.
be the wrong course of action.
exactly. And in many cases, people just don't understand the mechanics of the monetary system, but there's no new money being created. So that's a misnomer. If I can just move this
So one
slide.
of our attendees said, so how do you explain the increase in M2 if there's not new money being created?
So that's the M2, because basically there's been quantitative easing over the last 20 years.
Millennia, it feels like.
Yeah, there's. I didn't include the M2. Yeah, I didn't include the M2 chart here. I did in another article where you do see it. It's been just going up. And in fact, what I'll do is I'll just show you just on that very point, central banks. If you give me a second, I can show you. Yeah, here's your M2 money supply. So yeah, this is a function of increased debt and that working its way into the system. So
Okay.
In terms of the reverse repo, it has zero impact on money supply. Okay.
So what is Michael? To me, my wheelhouse is as a trader and not a macro guy that understands the plumbing like you do. I'd have to call a plumber. I'd have to call you. I sometimes I can change a light bulb, but can you explain to the audience what has been
Yeah.
going on for a while with the repo market and the huge sums of money coming in? And then the SOFR rate shot up, which implied
Yes.
stress and U.S. dollar demand,
Yes.
and then it came down rapidly. What the heck is going on with
So
these
so that
operations?
okay. So let me just show you here. I think I've got a chart of it. Here we go. Um, so the so let's look at the red line. The red line is the repo market. So that's what happens when the banking system needs to borrow money because it's got a liquidity crisis. It goes and borrows money. Now you can see there've been. I don't have a longer chart than 2023, but typically you don't see these big spikes. These big spikes are tend to be associated with a little bit of a liquidity crisis. And what happened or about 10 days ago, so there was this regional banking fear that things were getting out of hand because there were
Yeah,
some bad loans. So you can see it
right.
actually shot to $8 billion. Now, you 8 billion in the scheme of the whole thing doesn't seem all that much, but people only come to this particular window to borrow money if there's an emergency because it's more expensive, and it doesn't happen that often. And you can see there aren't that many red spikes. So yes, there's
It
something
doesn't
going
it,
on.
it doesn't look good either that they
Yeah,
have to do that, right? A lot of
exactly.
it's their, image.
100% right. So they don't normally do that unless they really have to. So there was concern that there could be a potential regional banking crisis. I don't have that particular chart um, on my system right now, but yeah, it looked very vulnerable. I think the ticker, the ETF is KRE, if I'm not
You're
mistaken.
you're
But anyway,
you're correct.
um,
You're correct. It is KRE.
what I wanted to just quickly show you, and I'll come back to some of these slides, is last week I was in Melbourne and I gave a talk on back testing biases to the Australian Technical Analyst Association. And I'm just confirming you can see my chart is
Yeah,
my
got it.
screen, my
Yeah,
desk. Okay. Um, so this was a 1 hour presentation. I won't bore you with the details, the granular details. And I'm also a little bit nervous that some of your audience might not be quantitative or systematic. I might be talking to very much a let's say discretionary audience. So I won't belabor the point, but basically my my talk was around the following issue: is most back tests are unable to replicate themselves in real time. And I'm sure you've all come across traders that have shown you these unbelievable backtest results, and you're scratching your head. It doesn't seem possible, and invariably it doesn't work out. And it's not just a problem of let's say the financial trading community. It's very much a problem with the broader research community as well. But yeah, here's some practical examples. Some of your viewers or your participants would probably have come across this, and I just want to highlight biases. These biases are applicable probably even more so in a discretionary environment as well. So what symbols should I include in my strategy? So let's say you've developed a momentum strategy, and now, what do you include? What time frame do you use? What look back period? All these kind of things are important decisions. What tends to happen is people only make these decisions after they've run numerous back tests, and then they cherry pick the ones that have worked. So basically, I'll come to something very practical right now. My approach, I believe the only way to counteract this is to use a integrated framework that basically is able to store every single backtest trial that you do and score you across the whole gamut of all the trials. Because what tends to happen is you cherry pick, and I've come up with a whole, I've lent on the back of Marcus Lopez de Prado, who's a very famous quant. He currently is the head of the quantitative R&D at the Abu Dhabi Sovereign Wealth Fund. It's got over $1 trillion under management, and he's a top academic in the space, and he's come up with a number of different formulas which I've incorporated into a backtest framework. But I'm not going to go into the detail. I just want to show you one particular example where I think it highlights this quite well. So basically, here's a strategy that I've run across 23 different symbols. It's a 200-day moving average across all these symbols. Okay, the world stock markets, and over the last 25 years, it hasn't done particularly well. This particular strategy, it's made an annual return, call it, of 2%. So without going into all those details, if you look at the underlying of all those 23, if you look at the individual backtests of all those 23, you'll see a number of them that are actually quite good. Some are making 326%, 320. So what people tend to do, I see it over and over again, is that they look after the fact. They say, okay, well, here's the three that I like, and here's my back test. So now they've taken 3 out of 23, and they've got a more favorable back test. What you've done here is there's a selection bias. You've cherry picked, and anyway, in terms of my framework, it helps discount these kind of things and normalize it so you can score and get a sense of how much bias is in your back test. But I'm going to move on from here because this, as I said, this might be speaking to the wrong audience for that. But I'll just speak a little bit about the markets because that's what you guys were talking about.
Yeah, I mean, I'm interested in what your bias is, if you have one, or a narrative for a market making new all-time highs, and they're really not being cash on the sidelines. It's just changed hands.
So yeah, my views. Yeah, my views. So I typically look at valuation first, and I like the Schiller PE. So very simply, the red line, yeah, the red axis here is measuring the Schiller PE, which is basically taking the rolling last 10 years of earnings instead of being more lumpy. And you can see that except for the period at the dot-com bubble, we're at the highest levels we've ever been. So the markets are very expensive. So that's my first concern.
People say that.
My other issue is, which maybe I'll talk about in a second, is the AI phenomenon. So a lot has been driven by, as we all know, the AI phenomenon, and I think it's got ahead of itself. I'm not alone. Many people are calling it a bubble. So if you put aside the pricing of the AI and all the rest of it, I just want to focus for a second on what I think is going to happen to jobs. Like, I seriously believe that the impact on jobs is going to be quite profound. And I try and speak to as many people as possible.
How about your job, Michael?
Well, what's been amazing for me is I've founded and exited over 5 different fintech companies. And so I'm used to employing a lot of people, programmers, and so forth. So this is my great use case. I'm glad you asked that, Dale. Is I'm currently writing some software that I hope to be able to launch in December. And I've been working on it for about a year and a half maybe. And it's just me. Prior to this,
you would have needed 20
we had an
20 people.
office in Kiev with 35 programmers for a previous company and I know for the project that I'm doing at least 15 to 20, and it's not because I'm a crap programmer, to be honest with you, but I'm using the tools available to me at the moment, and I'm paying 20, maybe $50 a month to having some of the best programmers working for me being AI. So I do code, so it helps because I think there are many traps that you can fall into if you know nothing. But a guy like me who's been around the block and has done this a number of times, it's a game changer. And I know that a lot of the guys who used to work for me cannot find jobs at the moment. They're, let's say, middle-level programmers, some with PhDs, and I've got a guy with a PhD in nuclear physics. He's struggling. He's in Germany. He's struggling to find a job. So, I mean, he's not working in nuclear physics. He's working in programming, in financial market programming. But yeah, I think it's going to have a big impact. In fact, when you just look at
so getting a gig as a security guard is going to be a great job.
Yeah,
absolutely. Oh God. Go ahead.
Yeah, so I mean, look at this. This is S&P 500. Yes, it's a linear scale, but so it might be a little bit more dramatic. But you'll forgive me for my scaling here. But you look at this chart, and if you don't think this is
parabolic,
yeah, then but it's very hard to call. So in my newsletter, I've been saying I've over the last 3 months, I've put 2% of our equity into puts, long dated puts. I'm underwater at the moment because the markets over the last, there was a little bit of a wobble recently where I thought, maybe that's it. But
it wasn't.
I'm cautious. I could not buy this market at the moment, and I'll just show you what I'm recommending. I wanted to show one chart before that price journey. I just wanted to show you the US. Everyone's talking about the US, but if I look at a couple of exchanges across the globe, for this year at least, the US is underperforming these other indices. Yeah, so I mean, the US has done a lot over a number of years. So here's my calls that I'm making at the moment, and I've been pretty consistent with what I've been saying for in some cases for a year or two. But so my first call is I would, if you're going to have exposure to the S&P 500, I would switch from the market cap, which is your classic traditional S&P 500, to the equal weighted index. And I think the best way to look at it, because I've used, I used dual axes here to show it independently, but the best way is the ratio. And the market cap version, based on the Magnificent Seven and all those other interesting tech plays, have driven this market way out of kilter. So I'm a reversion to the mean kind of guy. I always think things come back to normal over time.
Equilibriums.
Very hard to time it. So even though I've put 2% into puts, these are way out the money puts, long dated. They're June expiries for next year. So if I get it, if I lose 2%, it's insurance, but it'll cover. But yeah, so here's one trade idea that I've got. The other one that I like a lot is, and this one I've been pretty vocal on, and I nearly got stopped out, is I'm long China, and I'm using the Hang Seng as my proxy. I was just too nervous to use, and maybe based on my thesis, maybe one of the Shanghai exchanges would have been a better one. But yeah, so what I'm betting on, I put this trade on over here, so it's already over a year old. Basically, I'm saying China's going to outperform the US on a relative basis, and we won't go into the whole macro story. I just believe that China's going to play the long game, whereas the US will be a bit more reactionary. And it's interesting. No one in your conversation earlier brought up the fact that the US government is in shutdown for weeks now, and people are going to miss a paycheck. It's not even on the it's quite amazing. It's like not even on.
You're right. It is amazing. It is amazing.
I mean, that's a big thing.
Yeah, it is a big thing.
So yeah, I'm betting that this ratio is going to come all the way below the mean. Yeah. My other trade that I like, and
so you do mainly relative performance type trades, pair trades.
Yeah, at the moment I'm taking longer term views, so I'm not that active with my trading. Like, whereas you guys are looking at shorter term charts, and I'm nervous. I'm also doing a lot of, let's say, call it optimized portfolio allocations, that type of focus. So it's more longer term. It's like the 60-40 traditional portfolio with a tweak, that type of thing. But what I do like is healthcare versus the S&P. I think healthcare is very defensive. People are getting older, and
right.
I see this ratio going down. Yeah, so that's another relative bet.
So Mike, why don't you show people where they can get involved with you and how they can?
The best way, I'm not very good at marketing.
Navigating.
Yeah, let me.
Just put your website up.
S2N. What is my website? No, Signal to Noise. That's me there. Signal to noise.news. You sign up. It's free, and very happy to talk to anyone. You'll have my email address once you've signed up, and very happy to engage and share whatever I can on that. I know we could probably run in short on time here, but just one that has been, I've been very vocal on this. I believe Michael Saylor is a charlatan, and I think the whole micro strategy is going to blow up. And I'm not. So I've been a buyer. I've been in and out of Bitcoin for the last. I bought my first Bitcoin in 2012. So I've been a long term in and out of Bitcoin. But once again, like I find it I don't want to make a call against Bitcoin because I think one should have a very, very small portion of your portfolio. I've said around 1 to 2%, not more. But people who've been sucked in have all gone for this, or not all. A lot of people have gone for this micro strategy, and I really think what you're going to see, this ratio is going to go way through the top here. So I'm not a believer in the whole micro strategy thing. I think the average, I'm going to get it wrong now. So it could be, after all these years of buying and all the billions he's spent, I think his average price is either $79. Yeah, I think it is. It's called it $80 is his average. So anyway, we'll watch this one closely. And
Yeah,
my
you're not
last,
the only one. You're not the only one that I
good.
think Jim Chanos you have in your corner.
Yeah, I'm a great fan of Jim Chanos.
Okay.
One last call from my side is I'm a believer in like the yield steepener. I just, with all the debt that's still out that the US has to fund and roll, and I don't believe inflation is I've got a chart of inflation if you're interested in seeing,
Yeah.
but basically my trade is that the long end of the curve is going to go up. You've seen it. So this is the 10-year over the 3 month, and already the 10-year over the 2-year has gone up, and I see this continuing. You mentioned, one of your previous guys spoke on, I use this chart. I find it really incredibly accurate at predicting what the Fed's going to do. It's the 2-year over the Fed fund rate, and basically we're slightly below this, which tells me the Fed's behind the curve. So it's likely that the Fed is going to drop this green line in line.
Yeah.
Basically, I call the 2-year the better
How
than
long have they been behind the curve? And what's the repercussions, even though they're
not
cutting
that.
now?
I personally don't think they should be, because I'm very nervous about inflation.
Inflation, yeah.
Yeah, so
Well,
if you
he's
look at the
not
late,
Paul Volcker,
yeah,
we found
so
out, right?
yeah, so yeah, we're sitting at 3%. It's still way above. Anyway,
Yeah.
it's way above um, the inflation target that they've got. And I know you mentioned like wheat and the grains could be bottoming and all that kind of stuff. Cost of living is very high. So people who've got jobs will certainly
Maybe.
be looking for increases. My only concern that I have with my thesis on inflation is if there's this massive job destruction that comes through AI, is I can't see the inflation. So because without jobs, I'm not sure there'll be the spending, and so yeah, like I think people should not underestimate the impact that AI is having. I've spoken to a number of law firms, and they're telling me that slowly they now adopting more. I think these law firms are very nervous about privacy, and they've taken their time about whether they can deploy it in their companies. But basically, you cannot not embrace AI if you're a large organization. You just got to be smart about it. There still will be a need for jobs, certainly in the middle to higher level jobs, because you still need someone to look over the AI to make sure that it's doing the right job. And you can't do that if you don't have experience. So I think, Dale, you and me probably still got some value left in us, but it's pretty scary. I read a book while I was in Melbourne on the weekend called Scary Smart, and it was by one of Google's senior engineers who left, who was involved with the whole AI revolution, and like he's dead scared about where we're heading with this. So I
Yeah.
think anyone who's got a job should value it big time. Sorry to
Okay.
scare you.
Good advice. Good
Uh,
advice. Should
I'll leave it there.
value it at all times, as long as it's not an exploitive relationship.
Yeah,
And that's a wrap, Mike. Great.
yeah.
Thanks for staying up.
No, only a pleasure.
And
And
we'll talk again like in January.
great.
And you reach out
Thanks so much.
anytime you need anything, just let me know. And
Much appreciated.
everyone, you could follow Michael on X at S2NN.
Signal to noise
Yeah,
dot news.
yeah, but it shows up as S2NN new
Oh,
EWS.
on my Twitter handle. Yes, yes.
Yeah, yeah. So I'm giving them that.
Okay, I've
And
got to get more into the Twitter bit. I'm scared of Twitter, but
okay, well, you
I
know
know
what?
you're a master.
You're a man of faith. Don't have no fear. Do not
I have no
be
fear.
not be not afraid, Michael.
Be not afraid when Dale's near.
Be not afraid because God is near.
Yeah, 100%. Thank
All
you
right,
so much,
brother.
Dale.
Take
Thanks,
it
everyone.
easy. I'll see you, man. All right, that's a wrap, everyone. Could join the team in 10 minutes. Don't just count your money supply, count your blessings. Adios.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.